Ever get that feeling? You know that feeling like finance has its own secret language.
Mhm.
We're tackling one of those insider terms today, spreads.
Spreads.
Now, you've probably seen these spreads out in the wild, right? Stock prices, bond yields, even when you're just like swapping currencies on vacation.
Happens all the time.
But what do those little gaps really tell us?
It's fascinating. A spread isn't just one thing. It's more like almost like a detective's tool, right?
Yeah.
Depending on where you find it, a spread can give you clues about market sentiment, risk levels, maybe even hint at where the entire economy is headed.
Okay, so no more glossing over those numbers on the screen, right? Time to break out the magnifying glass. We're starting our deep dive into spreads with the basics, and for most people that means, well, the stock market.
Yeah, for sure. This is where most people, they encounter spreads for the first time, often without even realizing it. Think about when you're looking up a stock price. You'll see a bid price. You'll see an ask price. That, my friend, that's a spread in action.
Right, that gap between the bid, the highest price a buyer is willing to pay, and the ask, what a seller's hoping to get. That's our first clue, right?
Exactly. And the size of that gap, it could be surprisingly revealing. Let's take, say, a really popular stock like Apple, right? Tons of buyers and sellers constantly trading. That bid-ask spread is going to be super tight, maybe a few cents difference, if that.
High liquidity, low spread.
You got it.
But what if I'm like eyeing a company most people haven't heard of? More risk, wider spread.
Precise. Imagine trying to buy or sell something in, like, a ghost town versus a bustling marketplace. That's the difference in liquidity a spread can signal. A wider spread on that lesser-known company, it could mean it costs you more to trade, simply because there's less competition.
So not just about the price itself, but how easily that price can move. Now, that is insightful. And this is crucial, I bet, for those high-frequency traders, right?
Oh, absolutely. Fractions of a cent can make or break them. Their entire business model is built on those tiny fluctuations. But here's where stock spreads get even more interesting. They can also exist between different types of securities from the same company.
Wait, now you've got me intrigued. Tell me more about that.
All right, so think about a company, right, that issues both common stock and preferred stock.
Okay.
The price difference between those two tells us a lot about investor sentiment. Are they feeling bullish, betting on big growth potential? Or are they seeking that steady income from preferred stock's dividends? That spread can tell us.
So if that spread widens and preferred stock is getting more expensive compared to the common stock, that means
Could mean investors are getting nervous. They're willing to pay a premium for that perceived safety and that steady income, even if it means, missing out on bigger gains down the line.
Yeah.
Spreads, they're like whispers of market sentiment. You know how to listen.
all right, so we've seen how spreads work in the stock market, but now let's dive into the world of bonds.
Bond spreads, whole other ball game.
I'll be honest, bond spreads always seem, I don't know, kind of mysterious to me.
They can be, yeah. But that's what makes them so insightful. Remember how we were talking about stock spreads, how they reflect investor sentiment? Well, bond spreads take that concept even further. They can tell us about interest rate risk, credit worthiness, even give us a glimpse into the overall economic outlook.
So we're talking about more than just like whether interest rates are going up or down.
Way more. Take what's called the yield curve spread, for example.
Okay.
It's a favorite among economists, market watchers.
Right.
Essentially, you're comparing the interest rates of two government bonds with different maturities.
Right.
Like you take the 10-year Treasury note and the 2-year Treasury note.
And that difference between them, the spread, can actually, signal whether a recession is on the horizon.
It can provide clues, let's put it that way. Typically a widening yield curve spread, meaning that difference between the two rates is increasing, suggests investors anticipate economic growth. They're demanding a higher return for tying up their money for a longer period. They're betting on a brighter economic future.
Makes sense. They're willing to lock their money in for the long haul if they think they'll be rewarded for it. But what about when that gap starts to shrink? Or even flips, where short-term rates are higher than long-term rates. That's when we should start worrying, right?
That's when the alarm bells start ringing.
Right.
A narrowing, or even what we call an inverted yield curve spread, that often indicates growing fears of an economic slowdown. Investors get less certain about the future, so they flock to the safety of those long-term government bonds, even if it means accepting lower yields. It's a classic flight to safety.
So the yield curve spread is like a barometer for the economy's health. Starting to see why analysts obsess over it. But, bonds aren't just issued by governments. What about companies?
That, my friend, is where credit spreads come in.
Okay.
This is the spread between the yield of a corporate bond and a risk-free government bond with the same maturity. Essentially, it reflects the additional return that investors demand for taking on the risk of a company defaulting on its debt.
Gotcha, gotcha. So a wider credit spread means investors are, what, more concerned about a company's ability to actually repay its debts.
Exactly.
Okay.
Wider spread means investors are demanding a higher premium for that added risk. And remember our discussion about market sentiment. Credit spreads are incredibly sensitive to it. Take, for instance, the 2008 financial crisis.
Oh, I was just going to ask you about that.
Credit spreads during that time
Hmm.
exploded. Fear gripped the markets. Investors were terrified. Companies wouldn't be able to stay afloat, let alone repay their debts. So they demanded significantly higher yields on those corporate bonds just to compensate for that perceived risk.
Wow. So these tiny spreads, they can actually reveal a lot about the underlying health of companies, even entire economies. That's powerful stuff. But I have a feeling we've only scratched the surface of bond spreads, haven't we?
Oh, there's a whole world out there. I mean, you've got your liquidity spreads, which reflect how easily a bond can be bought or sold without impacting its price. You've got swap spreads. Those are used to assess credit risk in the interbank market. And then there are Z spreads, OAS.
Okay. So I'm getting the sense that bond market gurus could spend their entire careers dissecting these spreads.
Entire careers.
Maybe we can save those more complex spreads for a future deep dive, though. I think the key takeaway here is that bond spreads, just like their stock market counterparts, they provide these incredibly valuable insights into risk, potential return.
For sure, for sure. They're like little windows into market psychology, economic expectations. And just like we saw with stock spreads, even the slightest fluctuations can signal significant shifts in the financial landscape.
This is all fascinating stuff. But you know me, I always like to bring things back to real-life applications. So how do banks fit into all this spread action? How do they use spreads to, well, to make money?
Now we're getting to the heart of lending spreads.
Lending spreads.
This is where things get really relatable, especially if you've ever taken out a loan, opened a savings account. Banks, you see, they're essentially in the business of managing spreads.
Okay, so we've seen how investors use spreads to measure risk, potential return in the stock market, the bond market.
Right.
But let's bring this back down to earth for a moment. How do spreads play into, our everyday financial lives? Like, what does it mean for me and you?
That's where lending spreads come in. This is where it gets real.
Lending spreads, okay.
Banks, they are masters at leveraging spreads. Is how they make money from those loans they provide, even the deposits we make.
Wait a minute. So that interest rate I get on my savings account and the interest I pay on my mortgage, those are both influenced by spreads.
Absolutely. Banks basically operate on the spread between what they earn from lending money out and what they pay out to depositors like you.
Gotcha.
They're borrowing money at one rate, lending it out at a higher rate. That difference, that's their profit.
So it's like the old buy low, sell high, but with money.
You got it. And just like with stocks and bonds, the size of those lending spreads, they can fluctuate. Depends on a whole bunch of factors.
Yeah.
The bank's own borrowing costs, how risky they think the borrower is, the overall economic climate, all that factors in.
Okay, so let's use mortgages as an example, right? Because that's something most people have to deal with. When I got my mortgage, the lender mentioned the spread over the 10-year Treasury note. What's the connection there?
The 10-year Treasury note, our old friend from the bond market.
Right.
Remember, it acts as a kind of benchmark for interest rates. Lenders use that as a starting point. Then they add a spread on top to account for their costs and the risk that you might default on the loan.
So if the 10-year Treasury yield is low, that automatically means mortgage rates will be low too.
You'd think so, wouldn't you?
Right.
But here's where those spreads come back into play. If lenders start getting nervous about the economy, they see unemployment rising, housing markets cooling down, they'll widen that mortgage spread, protect themselves.
So even if that benchmark rate stays the same, my mortgage rate could still go up if lenders are feeling uncertain.
Precisely. And on the flip side, if lenders are feeling good, optimistic about the economy, they might be willing to tighten that spread to attract more borrowers. It's all a constant dance, managing risk, maximizing profits.
It's amazing how these spreads are like, I don't know, a secret code revealing what's really going on behind the scenes in finance. But we've got one last stop on our spread venture today. the world of currencies.
Forex spreads.
Forex spreads, all right?
Those are the, often overlooked, but always present fees that are embedded in every currency exchange transaction.
Okay. So, like, when I'm at the airport, right, exchanging dollars for euros, there's a spread lurking in there somewhere.
Exactly. Forex spreads are how those currency exchange kiosks, even your bank, how they make their money. The spread is just the difference between the bid price, what they'll buy a currency for, and the ask price, what they'll sell it to you for.
So no matter what, you're losing a little bit on the exchange, right? No getting around those spreads.
That's the game in Forex. But here's the interesting part. Those spreads, they can fluctuate like crazy. Depends on which currency pair you're trading, which broker or exchange you're using.
So it's not just about the US dollar against the euro. There are spreads for like all sorts of currency combinations.
Absolutely. You've got your major currency pairs, like the euro-US dollar. Those are heavily traded. They tend to have very tight spreads, just like those blue chip stocks we talked about earlier.
Right.
But then you've got your more exotic pairings, the South African rand against the Japanese yen. Those usually have wider spreads because there's less trading volume, more volatility.
So the more obscure the currency pair, the more it's going to cost you to actually exchange it.
Gotcha. It's all starting to make sense now. Spreads really are everywhere in finance.
They are. And once you understand how they work, you start to see those tiny little gaps between the numbers as, well, as valuable pieces of information. They can tell you about market sentiment, risk levels, even potential profit opportunities. Well, I feel like we've journeyed deep into the world of spreads today. From the stock market to bond yields, from mortgage rates to currency exchange, we've seen how these, what seemingly insignificant gaps can tell us so much about how finance really works.
It's been quite the deep dive.
Yes.
And the key takeaway for everyone listening is this. Don't overlook the power of the spread. Whether you're a seasoned investor just starting out, understanding spreads can give you a real edge.
Absolutely. So next time you see a bid and ask price or a yield curve or even that currency exchange rate at the airport, remember there's more to that spread than meets the eye. Pay attention, ask questions. Who knows, you might just unlock a whole new level of understanding about this fascinating world of finance.
Until next time.